And thank you everybody for logging in this morning. We do have a full day for you, so hopefully you've got your coffee ready to to stay tuned in. I'm going to be talking about the economic outlook, where we are and where we're going. And I just want to make sure that I thank you again. So thank you for all of you for joining us. It's not too early, but early enough. And I also want to make sure that I thank David Ripplinger and everybody in Extension for their help co-hosting this event with us and just for inviting us to be a part of this. And I also want to make sure that I point out that the the things that I report on today are part of a project that I work on with some of our students at NDSU. So I want to be sure that I give a thank you to mostly to Cole Nichols, and but thank you to them and the students who help us out with the things that we do here at NDSU. And just a little bit more of an introduction of who I am. I'm a professor of economics here in the Department of Agribusiness and Applied Economics. I also direct the Center for the Study of Public Choice and Private Enterprise. And it's really the center that is the conduit that's putting out the reports that I'm speaking to you about today. And so as I get started, I like to give you an outline of what I intend to go over with you. And I plan to start off with just going through some data. So we're going to spend a lot of time talking about data this morning. I know it's the most fascinating topic for everybody. But we're going to look at data on the national economy and the state economy just to get an idea of where we are currently. And then we're going to flip and focus on where we're going. And that's where we get into the muddy waters of doing some economic forecasting. After I complete that, we'll have hopefully some time for some Q&A. If you have questions, I do have the Q&A feed up on my computer, so I should see questions as they come in. So do feel free to chime in with those at any point in time, and I'll try to make a note of it as it pops up. So with that, let's go ahead and get started with the part on where are we? Where are we? And I'll start off with a discussion of the national economy, and I'm going to go through the main points of data that we typically report on in the economic outlook report that we are now releasing on a quarterly basis. So we'll look at GDP, the unemployment rate, personal consumption, net investment, corporate profits, and then we'll also talk just a little bit about some commodity prices in this talk, although I think you'll get more information about commodity prices in some of the later talks today. I'll focus on talking about oil. So let's take a look at national GDP, and these are some charts that I've pulled off of a system produced by the St. Louis Federal Reserve Bank. It's called FRED. All of the data that I'm going to present to you today comes from the FRED system, which is a great resource for keeping up with the most current economic data, but as well keeping up with historical data also. And so this is a chart of our national GDP that goes back to 2005. And for those of you that don't know, GDP is the broadest measure that we have of the overall production activity of the economy as a whole. So it's kind of like the baseline barometer of the overall health and growth of the economy. And when economists talk about economic growth, we're usually talking about GDP, gross domestic product. And what we know, if we've been paying attention, we know that we've had some recent downticks. Okay, so we really started having our downturn as early as the first quarter of 2020. So we see from fourth quarter 2019 down to first quarter 2020, we actually had a small 1.26% decrease in GDP, which was followed then in the second quarter of 2020 by a nearly 9% decrease in GDP. So many of you who watch the news will recall that this was reported as having been the largest single quarter drop in GDP in basically the history of us keeping a record of this. So a historic drop in GDP that was largely caused by the worldwide COVID-19 pandemic and the resulting shutdown in business and international trade that took place. But then actually we experienced, granted, I'll be honest, that after you have historic decrease in GDP, sometimes there's only one place you can go from that. And luckily enough, we did experience an increase in GDP in the third quarter of 2020. So GDP increased by about 7.5%. And that also was a historic one quarter increase in GDP. So that's where we are in terms of the baseline of national GDP. I spent more time talking about GDP than I will some of these other variables. But another really important thing that we want to pay attention to with regards to the health of the overall economy is in labor markets. And along with that decrease in GDP that we experienced in second quarter, we also saw the largest spike in the unemployment rate that we've ever had in the history of keeping records. So we went from our normal rate of about 4% to hitting nearly 15% with the onset of the pandemic. And the unemployment rate has been slowly, well, I shouldn't say slowly, it's been declining. So we're currently having a national unemployment rate of around 7-ish percent. And as I said, we'll take a look at what we might think these trends will look like in the where are we going section of this talk. Net investment, consumption, as I have it up here, is it's real personal consumption. So that refers to the amount of money that normal people spend on stuff. Okay, and again, we can see that we had a big decline in consumption that actually even started, and that's one of the tricky things, is that we actually did start to experience some of this decline in the first quarter, whereas most of the impact of the pandemic didn't hit until the second quarter. But in the first quarter of 2020, we were beginning to just get those first glimpses of information globally about the spreading of the coronavirus pandemic. But again, when we look at consumption, we did have this giant fall in the second quarter of 2020. But again, we see that there's also that uptick. So we have that downward movement and then picking back up. Net investment is a barometer for helping us know how businesses are doing and what they're planning. It has to do with how much firms are purchasing in terms of increasing their capital stock and investing in their productive capabilities. And again, net investment had a giant decrease when the pandemic set in. But again, we're seeing it jump back. Corporate profits shouldn't be surprising to anybody that they have also been on the decline. So I should point out, I should have pointed this out on the very first slide. I apologize. The shaded regions that are on these graphs produced by the St. Louis Federal Reserve Bank highlight for us the time periods in which the economy was in a recession. So I made these graphs to go back to 2005 so that they include the recession that we had in 2008. And then at the very end, you can see that there's also a shaded region. It's shaded a different color because we haven't declared the end of the current recession yet. But we we actually had an early declaration of the recession back in the second quarter of, or actually the first quarter of 2021. So the last bit, focusing on the national economy, is to look at the crude oil price. And as the pandemic was setting in, we saw and I should note that these prices here are for the West Texas Intermediate futures market. I know that the oil that's produced in North Dakota doesn't normally sell at the West Texas Intermediate price, but it moves closely with it. And the West Texas Intermediate prices are cataloged farther back into time, so it's actually a better barometer to use for a forecast model for the overall trajectory of the oil markets. But of course, we had this giant dip that took place in April, where the bottom just fell out of the oil prices. We actually experienced oil trading at nearly negative $40 a barrel. Oil companies actually had to pay people to store oil for them. Luckily, that giant blip didn't last very long. And we did have a recovery in the oil markets. The price is coming back up, but we're settling in at a price that's kind of fluctuating around the $40 a barrel mark. We'll note that we haven't been down to a 40, down to that price for quite a while. We had a dip previously in oil prices, but we had recovered, and we're feeling pretty confident with that nearly $60 a barrel price for quite a while. And the onset of the pandemic, with its impacts on international trade and shipping, have really had an influence on the overall demand for oil. So that's where we are in terms of the national economy. I also want to make sure that we talk about the state economy, because that's actually what we're here to talk about. But the national economy is important because the state economy depends upon the national economy and even the international economy. So we're going to take a look at several key variables that I track for the state: wages and salaries, the labor force, unemployment rate, gross state product, and total tax revenue. And we'll take a look at each of these in turn. So first, we have the total wages and salaries. And one of the things that you'll note about these state level series versus the national series, typically states don't report their data as fast, or don't track their data as fast as the national government. So much of the state level data isn't quite as recent. So we look at the end here, we really only have 1 quarter's worth of data from 2020 regarding the wages and salaries, okay? But we know that in that first quarter, we had a big decline in wages and salaries. For labor force, we do have data that goes a little bit farther, okay? But again, the labor force data is showing that we don't have as many workers. This can come from unemployed people who just give up on trying to find work. But the labor force also could include people who are nearing retirement age and deciding to take an early retirement because they don't want to have to go to work and wear a mask. We also, could be seeing that there are people leaving the state. So all three of these factors could be reasons why the labor force is declining. Interestingly, just as the labor force is declining, we're also seeing the North Dakota unemployment rate also have some significant increases. So we've had a really tight labor market in our state for quite a while, and that's been one of the big problems for industry trying to grow, is trying to actually hire people. There just haven't been enough people that don't have a job. Our unemployment rate had been hovering in the 2.5% range. But as the pandemic hit, our unemployment rate went up to above 9%. Not as high as the national unemployment rate, but significantly a great big increase from what it had been for our state previously. But of course, our unemployment rate fell just as it did for the United States. So here I'm showing the trends in the unemployment rate for the state, which are blue, along with the unemployment rate trends for the nation. And you can see that we both experienced a spike, but the spike in North Dakota in the unemployment rate was much less than what was felt nationally. Next up is probably one of the more important ones. Gross state product is basically the state version of gross domestic product. So it's a broad measure of the overall production that's happened inside of our state. And again, we don't have data for the state beyond the early quarters in 2020. So this data is just not produced that often. We do have Q1 data and Q2 data. And the state of North Dakota experienced a negative 1.83% decline in gross state product in the first quarter of 2020. In the second quarter of 2020, gross state product fell by roughly 11.5%. We don't have data for North Dakota on the third quarter. So in order to graph gross state product and gross domestic product together, I can't put them in the same picture in total levels, because gross domestic product is just huge, right? It's the overall output for the entire country, and gross state product for our state's really small. So we can't put those in the same picture. What I did on this slide is I put the percentage change, that is the growth rate of GDP and state gross state product on the same graph. And here you can see that gross state product in North Dakota, we'd actually, started declining, going negative below this zero mark before the pandemic hit. National GDP had a historic percentage decline, but our state gross domestic, or the gross state product of the state of North Dakota, declined by more in percentage terms than GDP. So our state's product was hurt pretty significantly. You can see that the U.S. government, or the U.S. gross domestic product, then experienced growth. We don't yet have data for the third quarter for gross state product yet. So there's a little bit more of a lag with that state level data. So we rely on a forecast to tell us what third quarter gross state product might be. And we'll look at that as we get just a little bit farther in the presentation. The other thing that, and this is one of the things that concerns me the most, is what are the trends going to be and the effect of this economic decline on the tax collections of the state of North Dakota. And one of the unfortunate things is that the officially reported tax numbers come in quite late. So the data that's available on North Dakota tax collections goes back to the most recent we have is still from 2019. So 2020 tax collections haven't been officially reported yet. Now, there are, of course, people in the state government that are collecting information about tax collections, but the state hasn't reported that data on to to the national databases yet. Typically, the state will do that once per year, and we won't get that data until after 2020 is over. So for all of 2020, we rely on forecasts really to tell us what the tax collections might look like for the state. And that brings us to what I think is the more fun part of the talk. It's where I get to talk about where it looks like we're going. And as I do that, what I'm reporting to you is the results of the North Dakota forecast model. And as I mentioned, the Center for the Study of Public Choice and Private Enterprise has produced a quarterly economic outlook report. The most recent one was just released this week. I'm reporting on that data and results today. So you're among the first to get to see this in any presentation for sure. But here I'm giving you a link that you can use to get to that report if you want to see, and actually all of the pictures that I'm about to show you appear on that report, as does some summary explanations. And as I mentioned, all of the pictures that I've shown you thus far, I've actually produced them using the FRED website. All of the data that I use in the forecast model itself also comes from the FRED database. And I'm not going to spend too much time geeking out on the overall methodology that we use in the forecast model. But for those of you who are interested, for the most part, the model makes use of vector autoregression. And it actually takes the form of what I would call a nested vector autoregression. So we have a model of the state, or sorry, we have a model of the national economy that's kind of at the high level. Below that, we would then model the state's economy as it depends on the national economy. And then below that, we model our metropolitan areas as they depend upon the state economy itself. So there's that kind of nested nature of the model. And anytime I talk about a forecast, I always want to make sure that I provide you with the adequate disclaimers. And this is, the ultimate thing to realize is that whenever an economist does a forecast, the one thing you can be sure of is that the forecast is going to be wrong. It's basically impossible, especially to precisely predict the exact numbers for the future. And I say that, but don't forget, you shouldn't hold your local economist to a higher standard than you hold your local weatherman. And just think about how many times the local weatherman has been wrong about what the weather is going to be like tomorrow. Or even, if we looked at the forecast for today, we might find that it's not that accurate. Even for today, something could happen that wasn't forecast. And so also keep in mind then that the forecast exercise that I'm showing you, we're forecasting data on a quarterly basis, and we're going out into the future as far as a whole year. Whereas your weather forecasts are typically focused on maybe just the week ahead. So we're also going pretty far into the future. So it's basically impossible for us to be completely accurate. Now, with that type of a disclaimer, you're probably thinking, well, if you have to give me all those caveats, why should I believe anything that you say? Well, even though forecasts might be wrong, the forecast still gives us really helpful information. And what do I mean by that? Well, I can just eyeball the data and get a general idea of some of the trends, but there are real deep patterns and interconnectedness between the different data series. And when we actually go through a statistical forecasting procedure, it reveals trends in the data that you can't get just from eyeballing it. So it reveals patterns that we can't just ascertain with our human eyes. The other useful thing is that forecasts allow us to examine certain types of hypothetical scenarios. I may have the opportunity to show you some of those depending on time. The other thing is that when we do forecasts, as long as the person doing the forecast reports things in the correct way, it actually shows us a range of possibilities. So I like to focus less on what I would call point estimates, that is precise estimates of what a statistic might be in the future, and more on, well, what are the overall range of possibilities? And that's part of what you'll see in what I present to you in the coming slides. So that leads us to the actual forecast, and I did run this on November 2nd. It's important for me to tell you that, partly because some of the data is released at different points in time. And we had all of the relevant data collected as of November 2nd. And we'll start, just like we did before, looking at the national economy. And I'll show you forecasts for the same variables that we looked at previously. And after the national economy, I'll show you the forecast for the state. And at that point in time, if there is time, I'll show you the forecasts for our metropolitan areas. And if there's not enough time, I'll just end before we talk about the metro areas. But here is the outlook for gross domestic product. And this, again, this is based upon the model results. And what we see in the data, we see that dip that occurred, right? That was the historic decline that we saw in the second quarter of 2020. And then we had a recovery. But note that that recovery did not bring us back to the previous level of GDP. So what do we see in this data series? Well, our expectation is that GDP is likely to be really flat going into the future, okay? We're not predicting lots of economic growth. We're not likely to see another quarter of historic GDP growth. Now, it could happen. So that's where I'm pointing out that this red line represents the actual forecast value, but then we have this green shaded area about that forecast. So this gives us what we call the 90% confidence interval. It tells me that roughly in a general sense, I could be 90% confident that the GDP will actually be somewhere within this range in the fourth quarter of 2020, okay? But notice that range includes, well, what could be really big growth or what could be another sharp decline. So usually, we would expect the thing to actually happen would be the thing that's kind of in the middle of kind of the extreme scenarios. But we're basically expecting, there to be next to no economic growth over the near term. And given the way the pandemic is moving currently, it doesn't look like the economy is going to have the ability to just restart and experience rapid economic growth. Now, the picture might look different, especially as we get as we get a response to the pandemic that allows us to go back to work and consume in the same fashion that we had before, and hopefully that's going to be happening soon. But for the immediate term, we're not likely to see much of a turnaround. The unemployment rate reflects, I think, a very similar type of a forecast, that we had that historic spike followed by a declining unemployment rate. But then, we're going to see likely a decline in the national unemployment rate, but it's declining at a very slow rate, okay? So we're not expecting to see those dramatic declines. But again, notice that we have this confidence interval. And especially for the unemployment rate, the confidence interval is really, really thick. That's because there's a lot of uncertainty. So the unemployment rate could have that uptick again, or it could fall, but we're predicting that the most likely scenario is for it to have just a slow, steady decline. Personal consumption, this is an estimate of the consumption habits of typical consumers. And again, we had that pattern, sharp decline, then we had a recovery. The recovery did not take us back up to previous levels. And we're predicting, again, basically a very flat trajectory for consumption patterns. Flat consumption, flat unemployment. These things contribute to that flat prediction for GDP. Net investment is kind of a bit of as it turned out, it was a really hard thing to make a forecast for. Okay, there's a lot of variation in the data. Net investment itself has been going up and down wildly. So the confidence interval on net investment is so big that it almost makes it not worthwhile to really talk about the prediction for net investment at all. So it's basically a huge confidence interval, so that almost anything could happen with net investment. So I'm not going to say anything else about it because, like I said, it's got just a huge confidence interval. But related to that big confidence interval for net investment is this projection for corporate profits. Keep in mind that investment comes from firms, and when corporate profits fall, firms have less money on hand to make those investments. And we don't yet have Q3 corporate profit numbers yet, but we're, of course, projecting that they're going to fall significantly. When GDP falls significantly, that nearly always corresponds with a fall in corporate profits, especially when we had the historic fall. And we're expecting, after this fall in the third quarter, for corporate profits to basically stay fairly flat at that lower level. We're not predicting in here really a recovery in corporate profits. But again, also have to keep in mind the confidence interval. And again, the confidence interval on corporate profits is very large, representing a huge range of potential outcomes. So we could, in fact, see a recovery. It's within what statistically would be expected. Okay. So I am going to shift and talk just briefly about commodities. When I gave you the "where are we" statements, I only talked about the price of crude oil. But I do recognize that especially our state's economy depends a lot on the price of a variety of commodities. And so the model does take into account what's happening in wheat, corn, and soy markets, and what is modeled for each of the commodities, wheat, corn, and soy, is the producer price index, which gives you an idea of how much producers have to pay to get access to these commodities. And then again, the crude price that we have here is the West Texas Intermediate Futures price. But they all follow a fairly similar trend. Okay, we're predicting that in the fourth quarter of 2020, a slight uptick in each of the markets. And then we kind of see maybe a small decline with then straight, a fairly flat scenario after that. So basically with crude prices, we're expecting crude prices to stay pretty constant at that roughly $40 a barrel trend that we're currently at. This is here mostly because these are all inputs into what I'm about to show you is the result for the state economy. As we make forecasts into the future, we have to forecast all of these variables to create the predictions for how things are going to go. So in the state, I'm going to show you data on, or projections for, total wages and salaries, labor force, the unemployment rate, gross state product, and total tax revenue. Same things we've looked at before. So in this chart, we can see that total salaries and wages declined in the second quarter of 2020. And we're predicting another big decline in the third quarter of 2020. The model does then have this kind of uptick, okay? So there's this decline and then a recovery, but note that that's followed by several quarters of successive declines. So the overall trend here, if we were to think about the overall trend that we're looking at, is basically a steady decline in total wages and salaries. And while that's happening, we also have our projected trends for the labor market, okay? So we've experienced a decline in the labor force. We're projecting that decline to actually pick up in the third quarter, okay? Or sorry, in the fourth quarter. This is third quarter is here, fourth quarter is here. So we're expecting fourth quarter a big decline in the labor force. After that, we're basically tapering off, very small movements and basically holding a steady trend after that. But the labor force is significantly lower than it was pre-pandemic, and we're not really predicting that we recover in terms of the size of our labor force within this forecast period. Again, I will note though that we do have our confidence intervals, so always pay attention to those confidence intervals as you look at these to get an idea of what could happen. So there was a question, and I'm fine to just answer some of these questions as they happen. So I did see that a question was posted to the Q&A. And the question was, if you're forecasting the economy in the short term during a pandemic, are you including any COVID-related variables in your model, such as cases, death, hospitalizations, etc.? No, this is not a model of the pandemic, and I am not modeling any of the response to the pandemic. The data about what's happening in the pandemic is inherent in the overall GDP levels and the data series themselves. So no, we're not directly modeling the pandemic at all. To do that is a completely different exercise, and you can't do that using historical trends, because the pandemic didn't hit until 2020. So you can't really build an economic forecast based upon that. So next thing to look at is our trends in the unemployment rate. So our unemployment rate experienced a spike in the second quarter, followed by a third quarter decline. And luckily, we're expecting the unemployment rate to continue that basic decline, okay? But note that in our forecast, we're predicting the unemployment rate to still generally stay above what it was pre-pandemic, okay? So we're not expecting the unemployment rate to go all the way back down to the pre-pandemic levels within the forecast time period. So we're not expecting a full recovery from the pandemic economy within our forecast period. And that's also evident in our estimates for gross state product, okay? So gross state product declined in the second quarter. Third quarter data for the state isn't out yet, okay? But our projections are that third quarter gross state product are going to decline and decline sharply. On the positive note, after we have that 1 quarter decline, we're then expecting gross state product to have a mild recovery. I'm saying mild because the projection, and I'll move this over, is that while we're experiencing growth, we're not expecting to get back to that pre-pandemic level until after this forecast period ends. So that'll be on into 2021, or sorry, on into 2022 even. Hopefully, as we move on into 2022, we might be getting back then to pre-pandemic levels of gross state product. That leads us to our estimates of total tax collections. And as I've mentioned, this is the variable that I guess is the one that I pay the most attention to, but it's also the one that we have the least amount of data for. So I'll just back up really quickly to the previous slide and point out the projections for gross state product basically start, we have data for second quarter of 2020. So the third quarter 2020 is the first quarter that we actually have to make a prediction for. For total tax collections, we don't have any data for 2020 yet. So we have to make predictions for all of 2020. But we're making those predictions based upon the other data series that we do actually have data for. And what we're seeing in the projections, and you can see the basic trend of this red line, it's moving down. And unlike some of the other graphs, we actually do have the zero here. So this is zero. We going up to pre-pandemic, our quarterly tax income was around one and a quarter billion per quarter. But you can see that the decline that we're predicting is quite substantial. If we were to think about what would we have been like if there wasn't a pandemic, the expectation would basically be that total tax collections would have been fairly flat, given the current trends. But we're expecting a fairly significant decline in total tax collections. Again, there is that confidence interval, but even the upper bound of that confidence interval tends to indicate slight declines in total tax revenue. So that's kind of like the best that we can expect is for the declines in total tax revenue to be small. But at worst, the declines in total tax revenue could be very large. So if you do have questions, and I know that I've already addressed one, do feel free to go ahead and type your questions into the chat or the Q&A box, and I'll see if I can open up and make sure that if somebody shares something in the chat, that I haven't been watching the chat box as closely as I have the Q&A box. So I'll try to address. I see that there are some comments in the chat. So one of the questions was about, and this was asked early on, thoughts on declining unemployment coupled with declining employment in recent months. Yeah, the interesting thing, and this is evident in our state level data, is that we have a decline in the labor force, which, if you think about what the unemployment rate itself is, it's the number of unemployed persons divided by the labor force, where the labor force is the sum of the unemployed persons plus the employed persons, okay? But to be considered unemployed, you have to be seeking a job. If you're not seeking a job, you're not actually considered unemployed. So what that tells us, especially when we have now unemployment rates declining, making the labor force smaller tends to make that denominator for the unemployment rate smaller. If you make the denominator smaller, that tends to make the statistic itself larger, okay? So the labor force declining by itself if we hold the number of unemployed persons constant, would actually make the unemployment rate get bigger. So the fact that they're both declining tells you that there are people who formerly were employed, but are leaving the labor force. So that's when I mentioned early on this possibility that we have people who are close to retirement and are deciding now in the current scenario that they're going to go ahead and retire. Or we had people who had potentially lived here and are now deciding to leave the region, and so they're being taken out of our regional labor force. Now, I'm not tracking that data specifically, but that's what I'm thinking in terms of these simultaneous trends in the unemployment rate and the labor force. I don't use county level data, just so you know, Stacy Swanson. I'll show the metropolitan data here in just a second. Yeah, there was a question regarding some data that wasn't included. If you're really interested in data selection for the model, I do have a technical appendix for the reports. There are some requirements that I used for creating the model. One of them is I only use data that I can access through FRED. So if it's not a data series that I can access through FRED, then it's not included in the model. And one of that is a point of practicality, that I can access data that's in the FRED database fairly easily, which allows me to update the model in a very consistent pattern over time. But also the way vector auto regression models work, you actually don't really want to include too many variables. The more variables you include, the forecasts can actually tend to not be as accurate. You end up having false levels of precision that happen in the forecast. So the VAR methods that I use are meant to be focusing on a small number of fairly all-encompassing variables. So I'll go ahead and come down to show you the trends for our metropolitan areas. So I'll do Bismarck, then Fargo, and then Grand Forks. These are presented in a different way than the previous ones in that I have multiple graphs all at once. So the variables that I track for the various metropolitan areas are measures of wages, the size of the labor force, the unemployment rate, and an index for housing prices to give us an idea of what's happening in the housing markets. And for Bismarck, we can see that and actually for the MSAs, it kind of works out so that at the national level, we have the most data. Then we have the next most data at the state level, and then is the cities. So we don't necessarily have tons of data available for the individual metropolitan areas, and that's reflected in some of these by when you see that red line kicking in. So excuse me, I need to take a quick little drink. But what we see is that total wages in Bismarck are predicted to be fairly flat. There is kind of this one-time spike. The labor force is predicted to decline. So and it's not likely to get back to pre-pandemic levels until after our forecast period. Whoops, sorry, didn't mean to advance like that. Bismarck kind of had a lot of variation in the data, which produced this very wide confidence interval, okay, which basically means that predictions about the unemployment rate are going to be hard to make. But it's a fairly flat trend, okay. Housing prices in Bismarck, so the forecast is that they're going to be on a downward trend. Lower housing prices would typically correspond with potentially people moving out, which could also happen along with the declining labor force. The Fargo outlook, again, wages have a lot of kind of movement. So there's a lot of variation in the predictions for wages in Fargo, but it is on a general upward trend. Labor force in Fargo is predicted to decline, but Fargo is predicted to have a recovery that actually gets us back to pre-pandemic levels for the labor force. And the overall unemployment rate in Fargo is expected to slowly decline as well. And it's expected to decline to close to the pre-pandemic unemployment rate. And the housing market in Fargo is also predicted to have a slight uptick in its values, especially in fourth quarter. And then as we look at Grand Forks, again, a lot of variation in wages. So it's been moving a lot. We also see the same trend that we saw for Bismarck in terms of the labor force declining. And when we look at the trend for unemployment rate, there's predicted to be a short-term decline, but then that unemployment rate might pick back up. So it's fairly, the prediction is fairly flat at current levels. And the housing price index is predicted to be basically pretty flat along the time period. So I'll take a peek here and see what other questions have popped up. So there's one in the Q&A box. The question is, how accurate were the predictions from the last quarterly forecast, since you now have recent data on how the economy played out? And how reliable are VAR models at predicting short-term impacts? So that's a very, very great question. One of the things that was tricky about and this was actually related to one of the other questions that was asked, is how am I modeling the pandemic? Now that we actually have data that's come in from the pandemic time period, I'm no longer doing what we previously had done, is we released a second special report that was specifically done to try to model trends post-pandemic. And that was based on the fact that we just didn't have that much data for the pandemic time periods. So for instance, we knew that oil prices were collapsing, but we didn't have much data on oil prices collapsing. We also knew that unemployment rates were doing very unusual things, but we didn't really have data collected for what the unemployment rates would look like in the pandemic. So we did some special reports, and those were I think better estimates than the standard economic outlook report that we produced. But the overall trends from the past reports have stayed fairly consistent. And the thing that I will say that's different at the moment is that I'll say that we're not painting a very rosy picture, okay, of what the economy is looking like, but that this is the most optimistic set of forecasts that I've produced. So the trajectory is better than it was. In terms of how accurate it was overall, I don't have a specific estimate or thing that I can tell you other than that we were predicting things to decline and things largely declined. VAR models one of the reasons that I use them is that they are known as one of the more accurate types of models that you can use for forecasting. But I always give that with the caveat that I gave earlier. Forecast models are not perfect. I'll see what other questions there are that I haven't addressed. So somebody was asking about the spike in the unemployment rate predicted in 2021. I'll go back to the North Dakota. So one of the interesting things also about the North Dakota economy is that historically, North Dakota has moved somewhat acyclically to the national economy. So very often when the national economy is growing, the state economy is shrinking, and vice versa. So some of those trends end up impacting things in terms of these spikes over time, or we're looking at the decline and then an increase. And there's this increase, but I'll say that this increase that's here is not very big. So I'm not really putting much stock in this little movement. I'm basically looking at there being a decline, and then I basically say it's kind of holding flat. So there's these quarterly projections, but there's so many things that go into these too that it's impossible to nail it down to one sort of factor. So I did have another question in the Q&A box. It says, although starting wages have been steadily rising, what is your prediction on the effect of a $15 minimum wage on the economy? And I don't know if the question was referring to maybe a national minimum wage or a local, maybe statewide minimum wage. So that's kind of outside of the scope of certainly the of the forecast model that we've looked at. But whenever we have a minimum wage that's put in place that's above the current prevailing wage, there's only a couple of things that can possibly happen. Predominantly, what tends to happen is that people that were earning just below the minimum wage, some of them go on to have a job with a higher wage rate, but there are some of them that end up not having a job at all. I would, to be honest, I would be very, very skeptical of trying to raise the minimum wage at a time when so many businesses that hire people at the minimum wage are also struggling. Minimum wages, to me, typically, especially at the national level, I think national minimum wages are a bad idea, mostly because different cities, different states have different labor market conditions. And I think that the state governments and the local governments are best equipped to handle those. But I don't think that North Dakota would probably handle a $15 minimum wage real great at the moment. I've written and commented on the minimum wage at several points in time in the past, so you're feel free to look back at some of my commentary on the minimum wage. But I am out of time and don't want to go over. I know that we have another great session coming up soon. So I'm going to log off and quit sharing my screen. But thank you all for your participation. I hope this was informative. It's a very, in some ways, a detailed view, but also a high-level view of what's happening in the economy. But please keep logged on if you want to come on for the next session, and you can, I think, log off and log back on as the day continues.